Assistance is run by a bunch of investment bankers, and their modus operandi.
Hello, I'm Fernando Luque, editor for Morningstar, and I'm joined today by Didier Saint-Georges. Didier is member of the investment committee of CarrmignacDIDIER. Thank you for being here, Didier.
Thank you. Hello.
Well, Didier, my first question is all about the economic prospects that Carmignac has. I know that Carmignac has been relatively negative on economic prospects for Europe and for the USA. Can you elaborate a little bit on this view and how this has translated into the portfolios?
Sure. Indeed, we have been quite conservative about the prospects for the economic situation in the US and in Europe, based on an indicator we developed internally, which indicated to us toward the beginning of the year that the economy in the US was about to slow down. And our concern was that at the same time, the US and clearly the Eurozone was in the process of putting in place very severe austerity plans, which in our opinion was going to make the slowdown even more severe. So on this basis, we started to position the portfolios toward the beginning of the year in quite a defensive mood. We created portfolios around January or February, which were centered very much on defensive sectors such as consumer defensive in Europe and in the US, gold mines, while we continue to keep the heart of the portfolio centered on our key theme, in our opinion, for the future years, which is consumer demand in emerging markets, which we believe offers very, very good visibility. And behind this defensive portfolio, we started reducing the exposure to equity markets via futures.
Well, yeah, I have to admit that Carmignac has been really successful in predicting, the last crisis. What is the secret of Carmignac in this sense?
There's no secret, or the secret is that there's no secret. It's simply the fact that we are very much a top-down house. We work very much on in-depth macroeconomic analysis, and it seemed to us that in 2008, the key point was to understand what could be the effect of this subprime crisis and the Lehman catastrophe on the real economy. And likewise in 2011, what matters, we believe, is to really understand what's going on in the real economy. And it's not about market timing or some kind of a short-term analysis. It is very much about having long-term convictions based on analysis, and that's what works.
Now the $1 million question: what is your central scenario for the Greek problem and for the euro in general?
It is worth at least 1 million probably. It is our opinion that an exit of any country, including Greece, from the Eurozone would be an extremely costly adventure. And therefore, we still believe that the most realistic way out of the crisis is for the Eurozone to move towards more federalism. Now the question is, politically, how will the European countries, including the so-called stronger ones, be ready to do it? Our fear is that it might require some more of a crisis period before, politically, some governments are prepared to move in this direction.
You mentioned your caution about Europe and about the United States, but you're very positive on emerging markets. And how does that fit into your strategy? Will the emerging market decouple from the rest of the world?
Yeah, that is another 1 million question, the decoupling. All these big questions do confirm the fact that we are a very important point on the markets, which are really worth spending some analysis on. Our central scenario globally is that Europe and the US will have a very hard time avoiding a pretty prolonged period of protracted growth, economic growth. So that doesn't make it very exciting for equity or even fixed income investments in Europe. But in this situation, the prospects in emerging markets could, all to the contrary, be quite interesting, because as much as they have been faced with inflationary pressures in the past couple of years, the slowdown in Europe, in the US, is helping them deal with inflation, because it puts down the pressure on commodity prices. And at the same time, the big difference between 2008 and today is the fact that these countries, which were very dependent on the US in 2008, a lot of their growth was coming from exports to the US. And these countries have been able to not decouple, but rebalance their economic growth and rely a lot more on domestic consumption. So that for the coming years, if we are positioned specifically on consumer demand, and of course certainly not on exports, well then the visibility, economically speaking, is actually very, very attractive.
Another issue that is worrying investors is the level of interest rates. I mean, they are at historical lows. Do you think they will continue to decline in the future?
Well, here again, the situation is very important to look at in a global perspective. In Europe, what you have is a huge discrepancy between the risk-free rate, if such thing as risk-free rate still exists. But so the German rates, the US rates are extremely low, and then of course the funding rates for the other countries suffer from very high risk premiums. Now the risk-free rates, can they go further down? Possibly, if Europe and the US do not manage the crisis properly, and the economies start really slowing down to the verge of recession, then why not? Yes, risk-free rates might go a bit further down. Look at Japan rates, and they are 1% for 10 years. So we are far from that still. So they could possibly come down a little, but of course not hugely. In emerging markets, it's very interesting because inflation pushed up the rates in the past 2 years. So if indeed inflation is starting to recede in emerging markets, then interest rates could come down quite a bit, creating, of course, opportunities for bonds in this region of the world.
Mm-hmm. Well, everybody knows that CarrmignacDIDIER has been and is still very positive on gold. Mm-hmm. Can you convince me that gold is not forming a bubble?
Well, the thing always to remember is that we invest in equities or bonds, but we don't invest in commodities, in physical commodities. So it's the same for gold. We're investing in gold mines, not in gold. Our job is not to speculate on the price of gold. Our job is to look at which equities are very cheaply valued, and it's the case for gold equities right now. As it happens during every crisis, gold price goes up, and the risk aversion is of course a big driver for gold price. And in those cases, the gold equities lag the performance clearly because they are equities. And it happened in 2008, and it happened again this summer. And as a result, right now, we are very positive still on gold equities because compared to the gold price, they are very cheap. In other words, they are a very cheap way to get access to gold. And if you believe that risk aversion will not disappear immediately, and on top of that, there is a risk of debasing for the large currencies in the world, the euro, the US dollar, the yen, and you want to hedge that risk by having some real assets, and clearly having an exposure to gold via gold mines, in this case, is quite an attractive proposition.
Mm-hmm. To finish this interview, I would like to hear your opinions or your comments on the last movement from the central banks providing liquidity in US dollar for the European banks. Does that change your view for the financial sector?
Well, this decision was interesting and was important because it was certainly the first sign of a true cooperation between the central banks. It sent a very strong signal that they would step in if necessary. It was preemptive because in reality, with the exception of a couple of banks, dollar funding was not much of an issue yet. So it was very good earning warning signal that the central banks were prepared to cooperate. It probably sends a strong signal as well to the governments, saying we, the central banks, are able to cooperate. So you governments, demonstrate that you can do the same. So that was very positive, and we can understand why the markets reacted quite positively. But in reality, one has to recognize the fact it doesn't change anything to the structural problem. It doesn't change anything to the need for deleveraging, both in the European countries and in the US. And it doesn't change anything to the risk of an economic slowdown. So fundamentally, it is good news, but it doesn't change the fundamental view.
Mm-hmm. Well, Didier, thank you very much for sharing your strategy with us.
Thank you for having me.
Thank you.
Run by investment bankers, and their modus operandi